to the first in what we hope to become a series of roundtable discussions sponsored by my firm and the firm for which Kevin Eckenrode, Andres Guevara, Kevin Verteric, Massimo Constantini work, and for whom Shrey Parekh and Sabrine Waisman advise. Our mission here at Marion Street Capital is solving the most pressing challenges for innovative growth companies. We are seeing that in this increasingly uncertain economic environment, one of those most pressing challenges is capital, and the appetite for funding even the most attractive of early stage companies in what's rapidly becoming a tightening liquidity environment. So with that as a little bit of an intro, I'm going to ask our four panelists to introduce each of themselves to our audience. We're going to spend the first 30-45 minutes covering a little bit of slide, visual material, and some topics I think will be of interest to some of the folks on this call before we turn it open to audience-driven Q&A. For those of you interested in submitting questions to our panel, there is a Q&A button. I'm using the local desktop app of Teams, so for me it appears right at the top of the app. For those of you using the web version, you may see it in a slightly different spot, but you've got the ability to submit your Q&A. You can submit that at any time during the hour. When we get to the Q&A section, Andres from our team is just going to kind of feed us some of the questions that he's pulled from the audience that he thinks may be of most interest to the audience, and we'll answer as many of those as we can. We'll wrap up right at 6 Eastern here. If we've got folks on that really want to cover, we've got any panelists that really want to stay on and cover more ground, I'm not going to stop anybody, but certainly we should plan on wrapping up by the end of the hour. Okay, so let's kick it off. John, you want to go first and briefly introduce yourself to our group?
Yeah, happy to. First of all, thank you for having me. Really excited for this discussion. Happy to be on a panel with such great folks and have an opportunity to hopefully answer questions, provide some insight from our experiences at Osage. So personally, I'm John Gallardo. I am an associate at Osage Venture Partners. Have been with the firm for about a little over 4 years full time. Prior to that, did some work in sales and business development for a couple of early stage startups here in Philadelphia, where I'm from and where I'm based. And then was fortunate enough to make my way into venture. So in terms of Osage Venture Partners, we're an early stage venture capital firm based in Philadelphia, as I mentioned. And the strategy is pretty straightforward. We're investing in early stage post-revenue B2B software. In terms of stage, we're typically getting involved when businesses are early, but have early signals of product market fit and real traction. So companies with anywhere from $500,000 to a few million of annual recurring revenue. And we're usually leading or co-leading seed or Series A rounds, usually writing an initial check of $1 to $5 million and reserving meaningfully for follow-on financings. And with those investments, try to be active investors and partners in the business. So the team here has a pretty diverse array of experiences as former operators, entrepreneurs, lifelong investors, but we really invest a lot into our portfolio and our community to surface best practices, resources, relevant networks, et cetera. And then lastly, we're investing in B2B broadly, but we've oriented ourselves around a couple of core themes, and that includes future of education and future of work. Thinking really that these two segments of the economy, these two critical areas of how we live have not changed drastically for the past century plus until a couple of years ago, really, where we saw quite an acceleration. And so we're excited to be hopefully investing at the forefront of that. And then we're investing out of the fourth fund of the strategy, which is $105 million in total commitments. That's us.
Fantastic. Thanks for that intro, John. Anthony, go ahead and give us an introduction.
Great. Yeah. Thanks, Sean. Hi, everyone. Great to be spending some time with you this afternoon. Thanks for joining us today. I'm the Chief Revenue Officer of Acera. We're a startup company based in Palo Alto. I'm also the managing partner and co-founder of Advia Ventures. So great to be able to share some insight, both as the operator in an earlier stage go-to-market company, as well as an investor in very early stage companies. At Advia, we invest with very, very early stage seed. We'll do add-on investments as well in all different spaces, a lot of things in AI, security, robotics. We're more about the people and the idea than a specific area of the market. So a little more general thoughts on that. And I've had a great opportunity to work with some great companies. I ran the field at a company called CloudBees, so open source CI/CD, if you're familiar with that concept in DevOps. I was at Splunk as an early employee, pre-IPO through $1 billion in revenue, running about 2/3 of the company business, and I have some background in quite a few other software companies. So I'm approaching the conversation from go-to-market perspective, and having a couple of different market spaces since about '99. So great to be spending the time today with everyone and a great panelist here. Thanks, Sean.
Thank you, Anthony. Nick, go ahead and introduce yourself to our audience.
Yeah, thanks, Sean. Nice to meet you, everyone. I'm Nick. I'm originally from Australia. I've been in the US now for about 4 years. I started my career actually as a radiation oncology physician. If you're not familiar with the field, we basically zap cancer with x-rays. And over that time, I looked after thousands of patients, and that kind of led me to my journey into startups. I basically wanted to take some of the pain points I was seeing patients and families go through and then apply it to this new field of digital medicine, which is digital health. I've co-founded 2 healthcare companies over the last 8 years. I'm currently working on Ellie, which is my second startup. We basically built an app that helps chronic disease patients live healthier and happier. And we do that primarily through audio content. If you've seen the movie Her with Joaquin Phoenix and Scarlett Johansson, it was very much inspired by that movie. We believe that the human voice is a very powerful driver of building relationships and having that human connection. And so we're applying it to chronic disease. And then separately, I'm also a venture partner within a small Australian VC fund called Black Nova VC. We invest in B2B focused companies. We've done about 25 deals to date, not just Australian companies, but also international companies. So yeah, like Anthony, I'll share a bit of perspectives from both sides, as on the startup side and then also on the venture side. Thanks, Sean.
Thank you, Nick. Thanks for joining us. Akash, go ahead and introduce yourself.
Sure. Thanks, Anthony. My name is Akash Jain. I'm an associate partner at VU, so we're a fund based out of San Francisco. We also have offices in New York and in Hong Kong. We typically invest early stage, so that's typically pre-seed, seed, Series A, a little bit of Series B. We usually come in with a check of up to $1 million in our initial check, where we typically co-invest and not lead, and then we would potentially do up to 10 million and lead a follow-on round. We don't really have a sector focus. We're mostly sector agnostic, geo-agnostic. We're just going after the biggest market opportunities, founding teams where we see a strong fit. As far as my own background is concerned, I have a lot of experience both as an operator and advisor in fintech. I was running my own startup right before joining VU about 4 years ago. And I'm also pretty deeply involved in just building and incubating fintech startups, some of which we end up backing internally at VU, and others who we sort of just kind of take from say 0 to call it 0.3, 0.4, and then spin them out, for them to go and sort of raise funds and be a little bit more independent on their own. I personally enjoy doing that a lot. So I do have, a fairly deep sort of operating perspective, particularly at the earliest stages when you're just getting started out. And then obviously on the investing side, I've been pretty deeply involved with almost all 65 investments that we've done to date.
65 will certainly keep you busy.
Indeed. Yeah.
Andres, would you mind advancing the slide deck? Why don't we kick off with some questions? So this is a graph of venture funding in $1 billion over the past couple of calendar years, where we're seeing venture funding, going through a little bit of a soft patch here. The team overlaid the purple line here, the NASDAQ, against that, the bars representing venture funding, and you see, a kind of eerie correlation here. So I just want to sort of open this up or throw this out to our panel in a very open fashion. When you guys look at this, what does this tell you, and how does that resonate with your experience? Who wants to take this first?
I guess I can take a, just reading. Can you guys hear me, by the way?
Yes.
Cool. Yeah, I mean, just looking at this, it is very, from the investor standpoint, what we've seen with, the graph going up and now more recently a little bit down is that there was a lot of FOMO being created for investors, where rounds were happening a lot faster, valuations were going up. Kind of like the housing market, where if you don't place an offer and get a house this week, then next week you're going to pay like 100K more, at least with the San Francisco market. So, pretty much founders are raising with a lot less stuff proven out. So things were not de-risked to the point where they would have been, say, at the beginning of this chart. So January of 2020, rounds were happening faster, valuations were higher. And you could almost argue that, what was the pre-seed was a new seed, and seed was a new Series A, et cetera, like all of those labels were shifting downwards. More recently, I mean, we've not slowed down our pace of investing at all. And I think fundamentally there's still a lot of dry powder sitting out there because, a lot of funds, especially dedicated pools of funds who've raised the capital already, they have to deploy it over the next 3, 4, 5 years. What you are seeing is a lot of maybe the syndicate capital or people who are doing deal by deal investing through SPVs. A lot of that has slowed down. A lot of corporate venture capital, even though more money is coming in from certain corporates. But some of the other folks who are investing more opportunistically from the balance sheet or from their personal sort of angel investing accounts, a lot of that has definitely slowed down, and as people are just trying to, I guess, build some sort of a thesis around, okay, what happens to the economy over the next 6 months to 18 months, which has maybe, brought back a little bit of brought the market a little bit more into rational territory. And I'm just talking from my perspective as an investor, where I feel like I have one extra day to do more due diligence, which is really what I'd like to do as a fiduciary of my LPs. And, even for some of the earlier stage founders, the bar is just a little bit higher, where you can't just go out there and raise on a deck anymore. Not for everyone, some people still can, but there's that one level more of okay, what is it that you've actually tested and proven out? So yeah, I mean, it's as this, and if you extrapolate this chart, or if you go back even more in history on this chart, you'll probably realize that, except for say 2021, we're still in some of the bars are still higher than at any other point in history. So there's still a lot of money going into venture, and it's still a great fundraising environment compared to at any other point in history. It's just not what was the norm, which had been established in 2021, which is a very short, I guess, window compared to the last 30 years of venture capital.
Yeah, I just add a couple of quick things. Totally agree with all that. I think to your point, actually, it's a good one. A lot of the pullback starts at the later stage, where a lot of what you might call non-traditional capital existed, either through corporates or the likes of Tiger Global or public market investors, crossover investors who've been particularly active. And I think that is where you typically see the pullback start to happen, and then it can slowly make its way down to the early stage. I think we're similarly at Osage seeing similar levels of deal flow that we saw throughout 2020 and 2021 and are not deliberately slowing down our investment pace. To your point, we have the same amount of capital to deploy, and we're coming off record years of fundraising. So the capital is still out there, but I think there's been a reset on a couple of things. I think one, there is a little bit of a lag right now figuring out how investors price deals, right? Multiples have been reset, but the value drivers have been reset as well. So whereas a lot of companies were able to raise capital with growth at all costs mindset, you'll see even in the public markets a tighter correlation between growth and profitability and versus valuation. And that doesn't necessarily mean that if you're a high growth early stage business, you need to be ultra conservative with cash and cash flow positive. But I think it does mean paying attention to the metrics that matter beyond just revenue and revenue growth. So what does capital efficiency look like? What do unit economics look like, which are critically important? And so I think now there were a large cohort of businesses that looked like great businesses and could be, but they need to figure out the metrics and the efficiency first before they can go back to market and raise capital. So I think that'll probably lead to a couple months, few months, who knows, of a little bit of a lag in terms of deal volume and capital volume. But then I think there's also a little bit of hesitancy because we don't know what's going to happen to tech adoption and budgets. We don't know how deep or wide this potential recession will go. And so I think at least at Osage, we're definitely being a little bit more critical about the types of markets we invest in and what those buying cycles will look like in 6 to 9 months from now. Whereas 12 months ago, there were industries that were seeing unprecedented acceleration because of the pandemic and the adoption of technologies. But I think we're starting to see a little bit of a pullback there in certain markets. So I think one, it's figuring out how we value companies, the value drivers and the metrics have changed. And then thirdly, is figuring out what's going to happen to tech adoption and budgets. I think if you're a great company, a great team, great metrics in a good and resilient market, to actually his point, I think there's plenty of capital out there.
Nick, what are you seeing?
So from a startup perspective, I look at the graph and I can kind of pinpoint a few signals that I saw on those months. So definitely March, April, we did meet some investment teams that put a pause on investments with things going on in Russia. So I think there was a bit of uncertainty in the market. I remember those months as definitive signals of this change. And then in May, the YC email leak of describing to their founders and portfolio companies that things are going to be grim for the next 6 to 12 months. And that was definitely a signal from in the market that investors maybe should take a step back, pause, and reflect on what deal flow is coming through. And that definitely, I think, grouped most investors into one or two groups, like we're talking about. One, just pause and wait to see what happens with the uncertainty. But then another group, which is a bit more bullish and thinking, okay, there are going to be less competition for some of these deals. We could get better valuations. So I think you're going to see a mix, but with a lot of the uncertainty, I think that's what's reflected here with this graph. And I can remember those two signals definitely happening with my startup journey.
Anthony, what are your thoughts on this?
I think it's all about sentiment, confidence, sentiment. You can, whether the sentiment comes from other economic signals or other conditions, or the sentiment comes from what's happening in the market, or sentiment comes from a FOMO that I think Akash, you started out with. I think it's all about sentiment. Confidence comes from sentiment, and I think you're seeing this confidence and sentiment going down as the market goes down. I think that's very simply, that's it. You can put a lot of other factors around it, but it's all I know.
So there are two sides to the confidence coin I want to explore with you guys. As we're describing it here, there's confidence from investors who, have the, let's call it the detriment of being able to log into E-Trade or Robinhood or whatever their app of choice is and see what the market is doing on any given basis, any given daily basis. And then there's confidence from the entrepreneur side. How important is entrepreneur confidence when approaching investors, and does that become more important in an environment like today's?
Sean, who are you posing it to?
Hey, go ahead, jump in.
It's an interesting question from our perspective at the Avengers. I'm looking early stages, and I think part of our ability and part of our value is seeing something in people that they may not see. So in other words, I don't expect entrepreneurs to come in and say and have a huge level of confidence. I expect them to have something in their eye. I expect them to have a market condition or a market situation that they're looking at, and then I expect them to have really just amazing potential and capacity. And I think as advisors and as board members and as leaders in these companies, it's our job to help these people become the leader, become the entrepreneur that they can. So for me, it's not about confidence in those people. It's about capacity and potential as an investor to bring out the best version of these people. The people have to have great capacity, bones, intelligence, skill. They have to have a great idea and time it in the right way. But it's not about confidence of the entrepreneur, at least from my perspective. And the other panelists may have a different opinion. So.
Yeah, Anthony, I think those are great points. I think we want to partner with entrepreneurs who are incredibly ambitious and crazy enough to think that they can, change industries and it's going to sound corny, but have an impact on the world. I mean, I think that's a unique trait of an entrepreneur. I think you need that from our experience to stay resilient through, regardless of what the economic environment's going to be. It's going to be a tough journey. And so I think we do want really ambitious founders, entrepreneurs. We want people who are confident in their abilities, in their product that they built, in the market they're in. We do also, at the same time, want founders and entrepreneurs who are aware of the current realities and, are practical about how to respond to them. So we don't, of course, want to see an entrepreneur come in and tell us that they're not going to grow next year, but we want to have a conversation to say, if things don't go up and to the right, as former operators on our team, they know that's almost never the case. How will you respond? So, looking at your financial plan, what God forbid, cuts would you make in order to save the company? What changes would you make to the hiring plan, to the product roadmap? We hope we don't get there, but we do like founders who think practically and scenario plan and maintain that confidence that they'll get through to the other side. And I do think we want founders, and listen, I think every investor wants this, entrepreneurs and founders who want to partner with you and want to work through challenging times and leverage your resources and networks that you can offer. Ultimately, we realize that we're not the ones operating the business, but again, I do think you want to, an investment is a marriage, and so you want to be able to work with someone who's going to be honest and pragmatic, but someone that you have enough confidence in to get behind. So that's my 2 cents.
Yeah, I mean, I think both the speakers, there's really not a lot else to add to that. Like when we're making an investment decision, we are factoring in that it's a 7 to 10 year journey and that there will be at least one downturn in that cycle or in that time period. So, we're making our investment decision regardless of what the economic condition is today. We're really focused on whether it's a consumer or an enterprise business. Are they really filling a need rather than a want? Will the dogs eat the dog food? Will they eat the dog food even when the economy starts to get tough? As John mentioned, buying cycles, budgets, all of those are going to get hit as the economy slows down. But then also on the consumer side, discretionary income goes down. So, we're underwriting and solving for those risks. Even like 2-3 years ago when the economy was really hot, we had that factored in. And really, I think what an entrepreneur coming to market today, it is a test of their confidence, because they're going to have to take maybe a slightly lower valuation. They're going to have to speak to a few additional investors. They're going to have to have a few, it's going to be a little bit of a longer fundraising cycle. So it is a good forcing function to really test their mettle, and whether they truly want to be in this journey or not. But from our perspective, it doesn't really change the way we evaluate the companies.
Nick, what's your perspective on entrepreneur confidence?
Yeah, I think naturally most entrepreneurs will always portray themselves as being quite confident in their business, the problem they're solving, and how they're going to grow the company. But I think it also has to fit in line with what's going on with the market. So I met a founder yesterday as an example, extremely confident with how things are going with the company. But then when I asked them about how much cash on hand, what's the runway like, they wouldn't really answer that question. So I think you can display confidence, and once you do grow down, they didn't have as much runway and it was more of a desperation round. So I think as long as you're transparent with financials and how grim things may be, I think building that level of trust early on, especially early on in the relationship, is quite important. And you can be quite candid, say, look, things aren't going as well, but this is our plan to actually address them and kind of grow the company. So I think, yeah, short answer, definitely be confident, but also be very transparent with actual tangible things with the company.
So Nick, that's fantastic. I want to explore that thread a little bit, because we do see a fair amount of that with entrepreneurs that have been building what seem to be interesting business models, but they're coming to us literally at a point of desperation or near desperation, and that's just so often an unworkable scenario for us, unless it's the type of deal where we feel highly confident about being able to put together 100% of the round to see them through to the other side. What advice would you give entrepreneurs that are avoiding that type of situation?
Yeah, I think generally, if for founders that are here on the call, I think it's always important to be very kind of practical with what you're trying to kind of solve and trying to kind of articulate. I think, yeah, most founders, it's more of a it's not as much, it won't feel as much of a level playing field. Yes, you are solving a problem that you're asking money for, growing the company to an investor, but it is also an opportunity for that investor audience. So you do need to kind of articulate your story and kind of structure your narrative that we don't necessarily need your money, but with your money, we could actually grow to all these amazing places together. But we're going to get there with or without you. So I think as a founder, to grasp that, it took me quite a few years to fully understand and appreciate that. I think if you can think of any of your fundraising efforts as it's a level playing field, I'm presenting an opportunity for who I'm meeting, and they have an opportunity to grow with us. I think that's really key, the key advice I'd want to share with any founders here on the call.
Anthony, what's your reaction to those situations you've encountered, whether it be on the operator side? I'm sure you've spoken with the companies that wanted your RevOps experience when they're at a point where you felt like this is just going to be too much of a lift given how long they waited.
What's my experience in trying to raise money, helping them to raise money when it's too late, Sean? Is that your question?
Oh, yeah, whether it's helping them try to raise money or just helping them try to, dig out of a situation through the sales side of it.
Yeah. So I think those are two very different ones. So on the sales side, but I think the common piece on this is that, and I think this slide makes a similar point. And the point is this: you can't force markets. You can only affect your timing in that market and your compelling nature of your offering in that market. So for example, Splunk when I was at Splunk, we were big data before there was big data. The right product, amazing timing, we executed really soundly. And if you go from pre-IPO to IPO in a couple of months and to a journey from we actually skipped quite a few steps in the growth journey, right? And in terms of that ramp up. So that was a market, it was a market timing thing. If we were a couple years later or a couple years earlier, it would have been a tough one. So maybe we would have done well, but I don't know if we would have done as well as we did. And the company still, obviously is still doing great. And this is quite a few years ago I was there. But I think the point remains the same. You can't force market. So if you're thinking as an entrepreneur to capitalize on something, it's about the timing in that market, and it's about how the market will change over time and how you can capitalize on the offering that you have. And if it's you have to have some foresight into it, because if you join it too late, then you're a me too, and it's hard to catch up. If you're too early, then there's a lot of tech companies that are littered. That's why the numbers are so staggering, from 0 revenue to 20 and then to 50 and 100 and above 200 and 250, because you have to have the right timing and the right market. So that's the biggest factor. And if there's a company that's missed the timing or missed the market, or maybe they're just not as compelling in the offering, you may have to look at alternative sources and make some hard decisions about getting closer to cash flow. And I think that's something we'll talk a little bit about around the expectations on it. But you may have to have some hard conversations and hard decisions if you're at that point now, and in order to have the company live, and go forward. So.
John or Akash, what do you think about avoiding desperation or near desperation situations for entrepreneurs?
Yeah. Well, first of all, it's obviously hard to say, to use an understatement, because to Anthony's point, there's a lot that's out of your control when it comes to market dynamics and economic environments. But and at the risk of sounding like an overly conservative East Coast investor, I do think it's really important to understand your metrics and to always be marching towards a path to profitability. That doesn't mean you need to pursue it. That doesn't mean you can't be aggressive and invest in growth. But I think if you maintain a path to profitability that allows you to be more agile and responsive to the current market realities. And so, for example, going back earlier to some of the metrics around efficiency that are now more important in this current market, I think understanding your unit economics is really important, because you could be spending a lot of money on a go-to-market model that just doesn't work. And it could seem like it's working because you're continuing to grow. But when you compare your average contract size to what it costs to acquire that customer, and then you think about what churn looks like, what margins look like, it could just not make sense. And so you need to be, I think, really critical about that and have a good grasp around it. And that then allows you to, oscillate between being aggressive and being conservative at the right time. And that ultimately would allow you to control your destiny too. So if you're approaching a challenging market environment, you know where to pull on the levers. So, okay, we know that these marketing channels are less effective. We're going to pull back all of our spend there. We're going to slow down our sales hiring, and this is going to get us to lower cash burn and extend our runway, or maybe it even gets us to cash flow break even, and we don't have to raise capital during this challenging environment. And so I know a lot of this is easier said than done, and certainly easier said in my seat, but I think just simple as paying attention to those metrics, working with your advisors, working with your investors to make sure you're on top of it and understand the levers in the business.
Yeah, I mean, I couldn't agree more. I think fundamentally, as John said, we don't know how deep or wide this downtrend is going to go, like what you're showing in your graph. So let's just assume that, this is going to be plan for the worst. So assume it's going to go down and it's going to stay down for a while. It's still not, if you made 2022 is still higher than pretty much every month in 2020, which is already a great funding environment. So it's still not like we're in a completely shut market. So, there's still a lot that founders can do as long as they just plan for the fact that maybe in 6 months from now or in a year from now, things could be a lot more worse, and it will bounce back. So it's not the end of the world. So there's no point to, shut shop completely or like throw your arms up in the air and be like, there's nothing to do. I lived through the previous financial crisis, and it's fascinating in hindsight how quickly we bounce back. It's just about having a plan to be able to weather that crisis, and that could, that's a function of extending a runway, starting to get creative as well. There's a lot of choices that founders make, and there's usually a lot of choices that they ignore because in an environment where things are just going up and to the right, people are telling them take more risks, burn more capital, et cetera, maybe just reconsider some of that advice. Maybe talk to some of the people who are a little bit more pessimistic, who've seen downturns before, and talk to them about what were, things that they did, which might have been unthinkable in the last 2 or 3 years. John mentioned, spend less on sales, maybe to hunker down, but then conversely, maybe spend more on sales and less on R&D, and just make do with whatever you have, but make sure that you're selling whatever you have in a market where it's working, and not test too many other channels. So every company is different, but this is the time to get creative and plan for the worst.
Great. Before I ask Anthony, sorry, before I ask you
just
a couple more, go ahead.
I think
go ahead, Anthony.
Ash and John got me thinking. I think there's a difference in looking at companies at a B stage or a C and even an A versus an early seed. So I kind of think that, and when Nakash and John were talking, made me think, like, I think from a planning stage very early on, I think that plan almost is a validate product market fit plan. And that's a bare build out of I don't like the term MVP, but some people use it, so we'll use it in place of another term. But build out the fact, validate the idea, validate the hypothesis, validate the pain that his problem is solving, validate you can sell, you can bring something to market that customers say is valuable and worth spending some money on, and validate that people will spend money on it. So that's one plan, and that's a very early on stage plan. That's not a that's a pre-product market fit plan. And I think today, in today's funding, it's really, really important for entrepreneurs to think about having that plan, because then that says that's kind of the worst case scenario plan. Here's what we need to do to build something out to validate that the market's there. And we believe that the market's there, but to the other point, you need to be honest about it. And then I think having a plan on pouring gas on the fire after product market fit is there, whether that comes in 6 months or 12 months or 18 months. But in terms of today, that's I think a really important way of thinking about the funding needed to get the product off the ground, because you can spend tens of millions of dollars on sales, but if you don't have product market fit and or the wrong salespeople for the stage of that product, you're going to burn through cash like in a bad way. So I think the planning has to be conscious around what the stage is of the company. And to Akash's point, every company is different, right? So, but I think that's really more important today, because there's a cash expectation or near cash flow expectation, lines are blurred between debt and equity funding, and even PE funding, as far as I'm concerned. So with the focus on cash today. So I think having different plans based on stage of cycle are really important. But Sean, I interrupted you, so I don't know. I think you were taking the conversation a different way.
Well, no, not necessarily, but I just wanted to remind our audience, please submit questions. We're going to get to Q&A in 5 minutes. So I'd like to have as fertile a field of questions to select from the audience. You can submit that using the Q&A button on the Teams webinar app. We're talking about introducing the idea of conservatism into planning for entrepreneurs who will be raising capital. For those of you currently investing, how much runway are you recommending entrepreneurs budget for before they need to do another cap raise, and has that time frame changed in the current funding environment relative to, say, a year ago?
I don't have to kind of explain it from my point of view. So one of our investors is Jason Calacanis. He was the first check into Uber and Robinhood and Calm and a few other companies. So I've got his Slack message actually up here. It's actually really well articulated. So I'll just read it out. So he said, basically, to make things super clear, only companies getting funded right now are the ones with growing revenue, cash in the bank, low burn, and a clear path to break even. He said we have 6 to 12 months in this bottom out period. It could be 3 to 6 months or 12 to 24 months, but I think 6 to 12 months would be more realistic. So if you have under 12 months of runway, the best course of action is to cut your burn by increasing revenue, raising prices, reducing salaries, doing layoffs, and focusing on your core business. So yeah, I don't know if it directly answers the question, but like, it sounds grim when you hear it, but it's a very practical way of like addressing how you can increase your runway past that 12 months while, you know, we've got things going on in this downturn.
Yeah.
Yeah, I guess like
Go ahead, Akash.
to elaborate on that, I was actually watching the All In podcast from Jay Cal yesterday, and I think him and David Sachs, you know, they were discussing this, and they were almost recommending 2 years worth of runway. And I guess that's really planning for the worst, where, you know, if you do have this thing stretch out for 2 years, then at least you can ride it through. You know, I think, which could, and that really comes through a combination of maybe raising a little bit more capital, but also tightening the belt up a little bit. And maybe 2 years is probably the absolute worst scenario and maybe unrealistic for some companies. But, you know, at least if that's your North Star, then you do whatever you can to extend it as much as you can.
Yeah. Yeah, I agree with that. I think we're looking at our existing portfolio and trying to help them figure out at least 12 months of runway, if not closer to 18. That's been our kind of benchmark. And, you know, it could be a little bit arbitrary, but I think to the point that both Nick and Akash just made, we don't know how long this is going to last. And, you know, I think it's unlikely that it'll last much longer than 18 to 24 months, particularly as it relates to companies' abilities to get funded. But so I think that's why we think about that range. And, you know, I think a couple other things, like if you're a company with an existing investor base, ask them what their appetite is for an internal bridge financing. We've led smaller internal rounds at maybe flat valuations or convertible notes with a slight step up in the cap, or maybe just a modest step up, because we believe in the company and maybe they're about to weather some challenging times, but we want to extend runway for them and allow them to focus on the business. And so I think in some cases might be surprised about how supportive investors are. I know that's not always the case, but so that's one. A second would be, we just had our CEO summit where we had 40 of our portfolio CEOs together talking about this very topic, many of whom are doing well, but they still want to plan for the worst, as we said, and want to extend runway. And the consensus was that it does no one good by making slow decisions. So if you are in the unfortunate position where you do maybe need to cut or pull back, the consensus was that you should do it quickly. Because the worst thing you can do is do it incrementally, and it just kind of, it's like ripping off the Band-Aid in you know, slow motion. And so you know, I do think it's important to make decisions fast and decisively. And again, I know that's easier said than done, but we have seen companies, you know, make those hard decisions early on and then come out thriving on the other end. So.
Great discussion here, folks. So one more question to the panel before we maybe start fielding some questions from the audience. We've talked about the change in the number of deals, the size of deals getting done here. On this slide, there's a stat, $500 billion of dry powder. I always look at stats like this with a degree of skepticism because the typical VC fund is raising capital on an as-called basis, right? So when you get into a tough environment, you're doing less deals, you're calling less capital, and then even when you do call capital, sometimes you've got some capital partners that flake out. When you see a stat like this, what's your reaction? Do you still feel like there's a lot of dry powder out there? Is it somewhere south of this, but still significant? How does the panel feel about it?
Yeah, I think you do have a right to be a little bit maybe skeptical. I would say that my guess is there is, a lot of dry powder as advertised, but where that number might be a little bit deceiving is that particularly, venture firms always reserve, in most cases, capital for follow-on investments or existing portfolios. So you have to assume a big portion of this is going to follow-on investments. And that's only more true during periods of economic uncertainty, where instead of making 18 to 20 investments per fund, we now might only make 12 to 15 investments and reserve more for our existing portfolio. And so, that'll change the number for sure. And I think that will actually put pressure on the markets and on the early stage as some investors maybe are forced to turn inward in their portfolio. But I think in short, it does seem like there's still plenty of dry powder, because we just came off this unprecedented fundraising year in 2021. So.
Yeah, and I guess even if there's some capital commitments that don't come through, and you bring up a really good point. I'm going to speak to one of my GPs too, who've done venture, through the previous down cycles, just to see what the stat looks like in terms of percentage of what percentage of capital doesn't actually come through when called in these tough environments. I'm really curious about that, but I'm guessing that it's it's not more than 20%, because there is serious penalties for people who are not able to fulfill those capital commitments. So those LPs do want to make those commitments. And the clock's always ticking. So even though the deals are being done on an as-called basis, the clock on your fund is still ticking. You can't pause that. So even if it's a temporary slowdown, it's going to, eventually average out, pick back up in a year or two from now, because that money has to get deployed in a certain time frame. The first two circles are more of a function of the markets, going up and down. So it's like the mark. The last one, it's a done deal. That money is sitting there, and it will get deployed over the next 4 years.
Nick or Anthony, your thoughts?
Yeah, I'd agree with what Akash mentioned. So I think some of the newer funds, especially the ones that raised before some of this downturn, they will need to allocate that capital. So there is going to be a willingness to do more deals. It's just the challenge, I guess, as entrepreneurs is how to find those funds that are actively investing. So whether it be panel like this, or even just looking in the market, which funds are doing deals recently is one strategy. But there are definitely funds out there. I know with Black Nova, we are actively looking for more deal flow, because we look at the market downturn as an opportunity to find better companies. So yeah.
So it's interesting that this slide seems to indicate that early stage is faring better than later stage, but I almost feel as if hearing the comments from the panel, that's just a lagging indicator. Okay, the IPO window in the public markets is clearly closed, so later stage companies aren't getting the IPO. So if they need funding, they're going to have to do maybe a down round or delay it as much as possible. But if capital allocators in venture are concentrating their portfolios, eventually that's going to mean less capital to go around for the early stage companies or lower valuations. So I lied. One more question to the panel. What are you guys seeing in terms of early stage, seed stage company valuations, and what do you anticipate for that over the next 6 to 12 months?
Yeah, that's a good question. There's definitely schools of thought that think that some of the later stage guys, like Tiger, they're moving earlier stage, and there's not early stages overall as a function of how big that asset class is. It's pretty small because each ticket size is much smaller. So even if even a small injection of capital is usually all it needs to say stay on course. Or even get even more heated up. So there's that one school of thought, and then obviously, we are in say a down cycle. Then overall, the macro environment is going to be there's some headwinds as well. So I really don't know what's going to happen with the early stage market in the next 6 to 12 months because on the one hand, there's arguably more money coming in, but on the other hand, there's also a slowdown happening.
Yeah, I agree with that. I don't have much to add to Kash's sentiment. It's the short answer is who knows what will happen. It's impossible to predict, but I do think and obviously haven't lived through this type of cycle from an investor's perspective yet, so it'll be interesting to see how it plays out. But at the early stage, there always is and always has been will be an opportunity to generate more alpha because you're investing at an earlier stage. And so while the valuation math is important, it's less important than later stage investing. And so even if the valuations in the public markets drop, for SaaS, I think it's like 60% off their highs, we can still generate a really good return because we're investing at such an early stage and high risk point of the company's life cycle. And so I think for that reason, there'll probably always be a lot of activity at the early stage. And to the point of the last slide, there's a lot of capital out there that'll need to be invested over the next 4 or 5 years. So I think the biggest impact is what kind of companies will get funded.
Okay. So let's start fielding some questions from our audience. I'll start with a question from Lainey. She's asking, she works connecting startups at different levels and pairing them with interested funders. What is the best way to open the conversation with a funder once you have an understanding of the company's business model and what might be special about that company? What do you guys like to see in terms of conversation starters?
I mean, the biggest factor for us is large markets, either today or in the future. But that's more of an, I guess, an external variable to the company. But speaking to specific entrepreneurs and founders, what we like to see is really like some sort of special insights, into what they've figured out or know from their prior experience, having lived through a certain problem or having worked in a particular industry. And that can be a function of, something that's special on the technical side, something that's special on the go-to-market side, something that's special in, it can be multiple levels. It doesn't just have to be like, oh, I have like the smartest scientist or the smartest technologist. It just has to be that one extra, I guess, like, because invariably there's always, others working on very similar problems, and you see, while the actual implementation of the solution varies, fundamentally a lot of people are always going after similar pain points. So it really comes down to, okay, who can execute the best and scale it up in, which in say 5 to 7 years, which is a very short amount of time to take something from zero to an IPO or through like an acquisition, which is north of $1 billion. So that clear understanding of how do you go from now to say whatever you do in 18 months, and then assuming that you get there, what do you do for the next 2 years and the 2 years after that, and all the way to an exit? At least one version of that storytelling all the way through is what we like to see, that someone's envisioned, that pathway to success from now all the way to like 5 to 7 years out.
Yeah, I totally agree with that, Akash. I would say, in terms of conversation starters, like what do you show in a deck? What do you highlight in your first initial conversation or intro call? I think internally we have this framework, a scorecard that we use when we're evaluating deals and force ranking opportunities because we can only really do high quality diligence on a handful of companies at a time. And so we try to prioritize our efforts pretty early on in the funnel. And we always ask ourselves, where's the 10 out of 10 across team, market, product, business model, traction. And I think sometimes we find that some companies try to appear to present the perfect company with zero risk. And I think at the early stage, invariably, there's always risk. There's always going to be gaps and holes. And so instead of trying to present a perfect picture, we found it more productive for the company to highlight what they view as the 10 out of 10. So is it a really large market with great market timing? Is it a phenomenal team with really unique insight into the market, with great domain expertise, with great business building experience? Are there metrics that clearly highlight product market fit? Is there something really defensible and differentiated about the business model or some type of network effect in the model? So of course you want to hit everything in a deck in initial conversation, but I'd really highlight the one or two things that you view as the key strengths of the opportunity. Investors are lazier than entrepreneurs, and so it always helps to write our investment thesis for us, in the deck or the initial conversation. So.
Sean, I want to add a thought or two. I think I think access to having the opportunity to share the idea comes great through forums like this. So I think being able to participate and as a panelist and put people together is great. So, but I think in terms of the entrepreneur, one of the things that we look at is really the why from the person. And the reason for that, and so I talked earlier about the market condition and what you can take advantage of there. Is it disruption? Is something ripe for a new way of doing it? Are the conditions fluctuating in such a way where this is opening up a whole new area? But it's the market itself, but it's on the person, it's the why. And the reason for that is that getting a company started and bringing something to market from a bare idea and being able to sell it is really, really hard. And you have to understand as an investor why the entrepreneur has a deep-seated desire for this and a commitment for this, because it's not a job, it's a lifestyle, it's a labor of love, and it has to come from a sincere intention. So there are a lot of different reasons. That's why I mentioned earlier, to look in a person's eye. So I agree with all the fundamental components and the analysis and the business case, the model and the planning. You have to have different types of models. I agree 100% on that stuff. But at the end of the day, if you're presenting to a group of entrepreneurs, I think that, or a group of investors, they need to understand the why. And that's a human element. That needs to come across in your story, in the conviction of your story, and they need to feel it, That's at least how I think about it.
We've got a question from Joey here. How do you guys think about your target ROI on individual company investments?
Yeah, so there's, I think the typical benchmark of investors looking for a 10x plus return on their investment, and I think that's certainly right. The outsized outcomes are typically, in venture math, the ones driving the returns on the fund. I think, in many cases, not every case, the top two investments are driving, 80% plus of the returns, if not all of the returns. And so the way we think about it is, can this investment return either half or the entire fund? And so as a $100 million fund, we want to see a path to exiting at a scale that'll return $50 to $100 million to us, knowing that this is a very high risk, high reward segment of venture investing. And so lots of businesses won't get there, but we want to see a path to doing so. And so that informs the types of markets we invest in, the types of business models we invest in, et cetera. But that's not to say you can't generate a great return at outcomes below that. But you just need to be, I think the biggest message is you need to be aligned with the investor early on in terms of what their return expectations are. But that's the math we think through.
Yeah, and I don't remember I was seeing this, but I think that, you know, sometimes what that roughly translates at a Series A, roughly like a 50x, and then a B 20 and 10 and 5x to basically return your fund, let's say $100 million fund, with that one investment. But like 10x is usually the minimum bar, but you know, it's but then it's also stage dependent in terms of just to be aligned on the risk reward spectrum at the right level.
Nick, maybe your thoughts before we wrap up.
Yeah, I think just adding to Akash's point, so like I think a lot of just founder advice for entrepreneurs on the call. A lot of the time when you're pitching your company or like thinking about the ROI for the investor, in the back of their head is like how you're gonna take like $1 and turn it to 10, like Akash mentioned. So like that has to be like clear, defining part of your introduction, the opportunity, the why, like Anthony mentioned, which I think a lot of founders might tend to like gloss over or like miss. But yeah, always have that in the back of your head is like, how can I articulate that I'm going to take $1 of theirs and turn it to at least 10 over what period of time conservatively?
Anthony, any additional color?
Yeah, the metrics I think are consistent, and you know, I think also being look, and this might be controversial too, but I think, you know, there's having some awareness of things you know and things you don't know, right? Because when you're talking about investing, you know, they're all, it's 1 to turn it into 10 and whatever, but it's hard to get to that point until you develop product market fit and you can hire a team of people that can either bring the product on, or you have a product-led growth model where the product is coming on itself. So it's very hard to get to a point where you can say, all right, I'll give you $10 and get 100 back, right? It's very hard to get to that point. It doesn't come till later. So you look for signs early. So I think as an entrepreneur, to say, hey, this we know, we have really good confidence in this. Here's the thought, here's the idea, here are factors that we don't know. You know, I think you gain some credibility with being honest around it. And and look, not every firm may think about it that way, but I think because you're kidding yourself if you think, hey, we're going to get it right the first time and the market's going to love it and people are going to renew and you're going to have net dollar retention of 152%. Like, it doesn't go like that, you know. So I think you gain a lot more points by being mindful of what you don't know. And I think the point was made earlier by John, Akash, and Nick. You know, you want to have an investment team and a series of board members who are there to help you figure these things out, because you're never going to know all these things. That's the advantage of having a group of folks who have a couple scars, maybe don't have great hairlines like me. And you know, they've been through a couple things here, and at least can play through it with you. And that's fun for us as investors too, right? To be able to really look back and say, we did this together and help these people become something awesome. So, because you're going to have to go through it on, you know, you're going to have those late night conversations and, you know, those moments. So, being honest around it, I think, establishes a good dialogue to start things off.
Fantastic. All right, so we're in overtime here. Why don't we wrap up with one concluding thought from each of the panelists aimed at our founder audience. Who wants to go first? Kosh, what do you think? What's the key takeaway for
the one thing, and I guess overthinking is a bad thing. So the one thing that comes to mind is just build something that people want, and not worry too much about what the financial markets are doing. Focus more on building and creating value.
Yeah, I mean, it's going to take you 10 years to get there anyway, right? To really build it, exit it, that's a reasonable time frame for expectation.
Mm-hmm.
Nick, what's your piece of advice?
Yeah, I like to always draw on like advice other founders have given me who've raised like at a later stage. So one that sticks out that I like kind of share with our portfolio companies is when you're fundraising and meeting different investors. Sorry if this like it doesn't land very well with some of the investors on the call, but like as a founder, you want to group whoever you're meeting into one of three buckets. Like bucket A is an investor who understands your market. You could probably tell very early on the call that they believe in you as the founding team, that you're going to solve the problem, and they have a deep kind of like knowledge of the market. Now, you're probably not going to meet as many investors in that bucket. You're probably going to meet more investors in bucket B who have some knowledge of your sector, have some interest, but they're kind of just going through the motions of like deal flow and like, putting you through diligence and like quite a few different steps, and you're trying to move them from bucket B into bucket A, but you're probably not going to get there. So you should probably spend less time actually on that bucket and identify that earlier. And then bucket C are those investors who like don't want to invest necessarily. They're just taking the meeting, and you can usually tell by, they're not taking notes or they're not like paying attention to kind of what they haven't looked at your deck or like looked at your product demo, that sort of thing. So try and spend as little time with that group if you can, and try and identify that before taking the meeting. One way I do that is I actually send our deck or our product ahead of time, and I can actually track part of my own diligence if an investor has like looked at those things or not, and then I can kind of like make an assessment in that way. But yeah, if you can, it's hard to do, but like with practice over time, it's just a numbers game as a founder.
That's great. John, what's your offer as far as concluding advice for our founders?
Well, I couldn't agree more with both Akash and Nick. And on Nick's point, I think trust your intuition. It's pretty clear early on whether investors are leaning in and believe in you and the mission, and certainly focus on that cohort of investors. And if you can, again, easier said than done. This is an obvious statement, but it does serve you well to create a competitive process. Get those folks aligned on the same timeline, and I think that'll be helpful. But the last concluding thought is that great businesses can be built in periods like this. I think, and oftentimes it's clearer to investors in the financial markets what those companies look like. But I love what Akash said, which is, just focus on building a great company, serving customers with a great culture and a great team. Something we didn't talk about today was just how difficult it is to hire and recruit talent. And so we love founders and companies who are as hyper-focused on their own internal teams and culture as they are on the customer and the market. That's just been a recipe of success in our small sample size, and I think more broadly. Three of our four most successful investments over the past now almost 20 years were made during financial downturns. And so great businesses can be built now. Be hyper-focused on your customers and your employees.
Awesome. Anthony, take us home.
Yeah, a couple things. I think a great idea is a great idea. If you have confidence in the idea, then exhaust every angle on it. So that's the first piece. The second piece is temporal. Everything is temporal. A negative downturn, it will change. An amazing, crazy market, that's not going to last forever as well. But to John's point, there are a lot of things that can happen in both sides of those markets. So you want to take advantage of the temporal nature of everything, planning for growth, planning for challenges. And I think the third piece, man, I think people are always at their best when they're having fun. So if you're engaging with venture partners, you have to be able to be in an environment, and John, you mentioned this, that where you're your best self, you have your own best natural energy, and you have a great culture, and you're picking a partner that can work with you. And I think that's, you know, you want to look at the phone when your board or your advisors, investors call you, and look forward to taking up the call. You don't want to have your stomach drop. So you need to be honest with yourself, it was said earlier too, and have fun with it. And you know, there's a lot of amazing entrepreneurs who do some pretty spectacular things, and it's fun to work with them. So I think as an entrepreneur, have confidence in yourself in that.
All right, so that's going to conclude our roundtable discussion on fundraising in a difficult environment. Panelists, I really want to thank you for your extended time and your expertise here today. I think it was incredibly insightful. Thanks to all the attendees who carved out time to attend this. Our team's going to get everyone links to the slides and a recording of today's events, so you have that for future reference. And if anyone's got any follow-up questions, please send them to someone on the Marion Street Capital team, and we'll reach out and see if we can get you a good answer to that follow-up question. So thanks again, everybody, and hope to see you again soon at one of these roundtables.
Great job, Sean. Thanks.
Thank you.
Byron.
Enjoyed it, Nikhil, Akash, John.